Is the landscape of commercial real estate changing in a way that will redefine how office and retail spaces operate? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. In a strategic move to enhance its financial performance and increase its engagement with tenants and customers, Blackstone has announced the creation of a new entity called Perform Properties. This entity is formed by merging three of Blackstone's portfolio companies, Shopcore Properties, Retail Opportunity Investments Corporation, and EQ Office. The newly formed Perform Properties is set to manage a combined portfolio of 33 million square feet across the United States, as reported by CoStar News. Blackstone, recognized as the world's largest owner of commercial real estate, is positioning Perform Properties to capitalize on the growing demand for experiential and amenity-rich environments in office and retail spaces. As workers return to the office, the focus has shifted towards creating high-functioning, high-impact spaces that cater to the evolving needs of businesses, employees, and customers. Perform Properties' portfolio includes more than 175 properties, with a significant presence in retail locations, 155 to be exact, and 20 office properties spread across 36 markets. Notable properties under this new umbrella include the iconic Willis Tower in Chicago and 211 Main Street in San Francisco, California. These properties are designed to deliver engaging experiences that attract tenants and customers alike. The restructuring aligns with Blackstone's recent acquisition of all outstanding common shares of Retail Opportunity Investments Corporation in an all-cash transaction valued at about $4 billion United States dollars, including outstanding debt. Perform Properties is expected to leverage the combined experience and operational strengths of its constituent companies to drive stronger performance throughout its portfolio. Alex Vuvalid, Chief Executive Officer of Perform Properties, emphasized the importance of creating spaces where people want to be, noting that success in today's market requires properties that perform for tenants, customers, investors, and communities alike. This sentiment is echoed by the recent changes in leadership, with Vuvalid's taking the helm following the exit of Shopcore's former CEO, Mark Ricks, during the merger process. For years, developer Femi Karahan gazed across the street from his thriving shops at Legacy in Plano to the cornfield on the other side of the highway. He envisioned it as a place to outdo himself, creating something even better. The result was the 240-acre Legacy West, developed by Karahan Companies and Columbus Realty, which opened in 2017 at the southwest corner of the Dallas North Tollway and State Highway 121. Retail guru Mark Massenter of Newmark's Open Realty Advisors was tasked with securing key tenants and had a clear vision. "We're not doing a department store, guys," he declared. "We're going to do the Ferry Building. That's going to anchor our project." This vision materialized in the form of a food hall, affectionately dubbed the Fun Building, which has become a popular hub at Legacy West. Sten Parton and his company, Prism Places, joined the team to develop programming and curation. Before Prism's involvement, Legacy West hosted about 15 events annually. That number skyrocketed to nearly 800 events in just 1 year. Parton emphasized that success in retail and mixed-use development is a combination of being a physical environment, constantly engaging with public spaces, and driving foot traffic and sales. The Legacy West project was founded on principles of never settling, continual self-improvement, and breaking new boundaries. It recently achieved a record-setting $785 million sale, placing the mixed-use destination in the hands of Kite Realty Group and GIC, a Singaporean sovereign wealth fund. Legacy West was built on the success of the shops at Legacy, which began on the east side of the Dallas North Tollway. Despite initial skepticism, it thrived thanks to its location near Ross Perot's Legacy Business Park. Over time, it expanded into a vibrant social hub, inspiring similar projects nationwide. Karahan's vision for Legacy West was ambitious, creating a 35-acre mixed-use destination anchored on one roughly half-mile street. Construction began in 2015, and today, the central artery, Windrose Avenue, features a mix of luxury and casual shopping experiences, public fountains, and detailed landscaping that evoke feelings of a Paris cafe or a Miami street. Massinter and the team were aspirational from the start, hoping to attract luxury brands by executing a strong first phase. The strategy paid off, drawing tenants like Tesla, Fabletics, Coach, Gucci, and Johnny Was. High foot traffic and sales made the destination attractive to retailers, turning Legacy West into a nationally recognized brand. Over the past 5 years, Legacy West has seen a 47% increase in gross sales per square foot, a 63% increase in net operating income, and occupancy rates for office and retail spaces exceeding 95%. Parton noted that few assets have such a story, especially in a competitive market like Dallas. Eastdil Secured advised Invesco in the sale, with key players including Jeff Scott, Chris Hoffman, Ryan Reed, Casey Shipe, Elizabeth Malone, and John Becker. Despite challenging market conditions, the deal attracted significant interest from global capital, public REITs, and private investors, underscoring the uniqueness of the asset. Carahan expressed hopes that the new owners will maintain Legacy West's qualities, character, and community-supporting events. Massinter and Parton see potential for further success, despite looming competition in North Dallas. Legacy West's story is a testament to continuous improvement and the courage to take risks. Grocery-anchored shopping centers have emerged as a prominent trend in the commercial real estate market, catching the attention of investors across the United States. This shift comes at a time when other property types, such as office spaces, face challenges. The Philadelphia region, in particular, has seen a surge in interest for these types of centers, with recent transactions highlighting their appeal. A notable example is the sale of the Eagle Plaza Shopping Center in Voorhees, anchored by Acme, which fetched a price of $41.7 million United States dollars. This transaction underscores the growing importance of grocery-anchored centers as reliable investments during uncertain economic times. The appeal of grocery-anchored centers lies in their stability and consistent foot traffic. Unlike traditional retail spaces, grocery stores are considered essential businesses, attracting regular customers. This consistent demand makes them attractive anchors for shopping centers, drawing in supplementary tenants and boosting overall business performance. As a result, these centers are perceived as lower-risk investments compared to other commercial real estate assets. In the Kitchener-Waterloo region of Ontario, Canada, the trend is also noticeable, with developers and investors eyeing grocery-anchored centers as a strategic investment. This is likely due to their proven resilience and ability to adapt to changing consumer behaviors. With the increasing preference for one-stop shopping experiences, these centers provide a convenient solution for consumers, which in turn supports tenant occupancy and rental income stability. On the American side, similar trends are observed in cities like Philadelphia, where grocery-anchored centers are becoming the darling of real estate investors. These centers are expected to continue drawing significant interest from both local and international investors, driven by their fundamental role in communities and their demonstrated ability to weather economic fluctuations. Plans have been filed to redevelop a 100-year-old building at 1663rd Street in Bensonhurst, Brooklyn. The project, spearheaded by 63rd Street Realty YI LLC, is set to transform the century-old commercial space into a modern office and commercial hub. This initiative comes in light of newly approved zoning regulations that allow for significant expansion and redevelopment of older structures in the area. The building is expected to more than double in size, providing ample space for new businesses and office tenants. This transformation is part of a broader trend in urban redevelopment, where historical buildings are repurposed to meet contemporary commercial needs. The redevelopment of this Brooklyn property highlights a growing interest in revitalizing older structures to accommodate modern businesses, a trend that is also evident in other major cities across North America. In the Kitchener-Waterloo region of Ontario, Canada, similar projects are underway, focusing on the adaptive reuse of historical buildings. Developers in this region are leveraging the unique character and central locations of these older properties to create vibrant commercial spaces that attract both tenants and customers. This approach not only preserves the architectural heritage of the area, but also contributes to the local economy by providing new business opportunities. Across the border in the United States, cities like New York are embracing similar strategies. The redevelopment of the Brooklyn building is a testament to the potential of these projects to breathe new life into aging structures. By modernizing these spaces, developers are creating environments that cater to the evolving demands of businesses and tenants, ensuring that these historical buildings remain relevant and functional in today's market. The revitalization of historical buildings for commercial use is increasingly seen as a sustainable and economically viable option. It allows cities to maintain their historical charm while providing modern amenities and facilities required by contemporary businesses. This trend is likely to continue as more cities recognize the value of preserving their architectural heritage while adapting to the needs of a changing commercial landscape. In our Beyond Insights quarterly market update, we delve into the evolving landscape of commercial real estate amid significant global economic shifts. While recent headlines have focused on rising tariffs and heightening geopolitical tensions, factors that continue to impact construction costs and supply chains, the United States Department of Housing and Urban Development is advancing efforts to address long-standing supply challenges. Under the leadership of Secretary Turner, HUD is prioritizing initiatives that leverage existing programs to support development without requiring additional appropriations. A key focus is on enhancing process efficiency and regulatory clarity, an approach designed to make current resources more accessible to developers and capital providers. These efforts come at a time when inflationary pressures, including those influenced by tariff-related cost increases, are creating new obstacles for housing production. One program drawing particular interest is HUD's 221D4 offering, which provides non-recourse construction to permanent loans with 40-year amortization and fixed-rate terms. Long utilized for its predictability and scale, this program is being re-examined by both developers and institutional investors as a potential catalyst for new multifamily construction, especially in markets facing growing affordability concerns. The renewed attention to HUD tools comes as multifamily permits and starts have fallen sharply, down 38% and 40% respectively, since the third quarter of 2022. Many analysts project a significant supply shortfall by 2026 to 2027, prompting investors to adjust underwriting assumptions and consider long-term strategies to meet anticipated demand. Despite persistent challenges such as elevated interest rates, rising insurance and labor costs, and oversupply concerns, investor sentiment remains optimistic. According to our multifamily investor sentiment survey, 65% of our investors plan to moderately expand their portfolios this year, while 18% anticipate aggressive growth. Encouraged by signs of moderate market recovery, many investors continue to pursue strategic opportunities despite economic and operational hurdles. In the near term, capital market volatility is poised to remain a staple. However, institutional capital is not retreating, but shifting towards more defensive strategies and high-conviction investment theses. Public-private instruments like HUD loan programs, alongside traditional agency and balance sheet executions, are likely to become critical components of the commercial real estate capital stack in the months ahead. Public-private collaboration remains key to addressing affordability and supply challenges, and stakeholders across the housing sector are watching closely as HUD refines its approach to meet the needs of today's market. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.